Hello everyone and welcome to my channel Econ Inflect Knowing Everyday Economics. This is part 3 of my banking series where I'll be sharing the instruments of credit control by Reserve Bank of India. For knowing the meaning and functions of Reserve Bank of India and commercial banks, and to understand the detailed process of credit creation by commercial banks, you can watch part 1 and part 2 of my banking series, the link for which is in the description box. So let's get started. There are two techniques of managing the flow of credit in the economy. One is the qualitative credit control and the other is the quantitative credit control. These are managed by the Reserve Bank of India, though RBI does not directly deal with the public, but by changing or influencing the rate of interest for commercial banks, it indirectly influences or regulates the flow of credit or money supply with the public. So let's understand the difference between the two first. Quantitative credit control is basically it basically regulates the flow of credit in the economy, the overall flow of credit in the economy by changing bank rate or by changing reverse repo rate or open market operations, cash reserve ratio, etc. Whereas qualitative credit control regulates the flow of credit through direct impact on a particular sector of the economy. For example, we have theory of margin requirement. So agar margin if say for example a person takes a loan from the bank against a collateral, तो जो value है collateral का, the person does not get a loan equivalent to that. कुछ portion gets deducted from the value of the collateral and the remaining part is given as loan. तो जितना ज़्यादा value of collateral में से deduct किया जाएगा margin, उतना कम लोन दिया जाएगा and vice versa. So this is one of the way through which it impacts or diverts the flow of credit from the general public. So let's understand them in detail. Under quantitative credit control, we have bank rate policy, open market operations, variable reserve ratio. Whereas in qualitative credit control, we have regulation of margin requirement, credit rationing, regulation of consumer credit, and direct action. The first, we have Reparate or repurchase agreement. The interest rate at which the Reserve Bank provides overnight or short-term liquidity to banks against the collateral of government and other approved securities. Basically, like we take loan from commercial banks, similarly, when commercial bank take short-term loans from Reserve Bank of India, the rate of interest charged is repo rate, and both the banks sign a repurchase agreement declaring that the securities will be repurchased by commercial banks on a predetermined date and price. The current rate, repo rate, is 4%. Then we have bank rate. It is the rate at which the Reserve Bank is ready to buy or rediscount the bills of exchange or other commercial papers. The current bank rate is 4.25%. The major difference between the repo rate and bank rate is that repo rate is the rate where the RBI lends to commercial banks by purchasing securities, whereas in bank rate there is no purchase of securities as such. There is some sort of collateral involved under repo rate, whereas no collateral is involved in bank rate. Repo rate is lower than the bank rate, and repo rate is basically providing short-term liquidity to the commercial banks, whereas bank rate is charged for providing long-term liquidity to the commercial banks. And repo rate is the rate that actually influences the flow of credit in the economy. Next, we have reverse repo rate. This is the rate of interest charged at which the Reserve Bank absorbs liquidity on an overnight basis from banks against the collateral of eligible government securities. When we have extra funds with us, we park our funds as deposits under commercial banks. Similarly, when the commercial banks have excess funds with them, then they park their excess funds, or they put their excess funds in the accounts with the RBI, and the rate that they receive from RBI is the reverse repo rate. And also, जो हमें लोन पे रेट ऑफ इंटरेस्ट देना होता है, it is generally higher than the rate of interest that we get on our securities or on our deposits in the savings deposits in the commercial banks. Similarly, the rate of interest that commercial banks pay to RBI for taking loans, which is known as the repo rate or bank rate, that is higher than the rate that they receive from parking their extra funds with the RBI, which is known as the reverse repo rate. So in short, what I'm trying to say is that reverse repo rate is lower than the repo rate. Currently, reverse repo rate is 3.35%. Next, we have cash reserve ratio. This is the average daily balance that a bank is required to maintain with the Reserve Bank of India as a share of such percent of its net demand and time liabilities that the Reserve Bank may notify from time to time in the Gazette of India. So basically ये वो part होता है, वो percentage of reserves होता है that every commercial bank has to keep with RBI, and it is currently 4%. Then we have statutory liquidity ratio, which is the share of net demand and time liabilities that a bank is required to maintain in safe and liquid assets such as unencumbered government securities. ये वो securities होती हैं which are free from any condition or legal obligations to another party. They are actually the full property of the owner. Changes in SLR often influence the availability of resources in the banking system for the lending to the private sector. It is basically that percentage of reserves or securities that a commercial bank has to maintain with itself in order to maintain the liquidity, just in case the depositors come and withdraw their money. So the banks should have a minimum percentage of liquidity with them. The current rate of SLR is 18%. Next, we have open market operations. These includes outright purchase and sale of government securities for injection and absorption of durable liquidity respectively. Basically, in order to control inflation or contract money supply in the economy, RBI sells government securities, and as a result it sucks the liquidity from the market. तो वो जो है money supply को contract कर देता है, and in order to expand money supply in the economy, RBI buys government securities and injects liquidity it injects liquidity into the market. So it increases the flow of or the money supply in the economy. Next, we have margin requirement. It is the difference between the value of a security or a collateral offered for loan and the actual amount of the loan offered. For example, if the value of the security is rupees 4,000 and the margin requirement is 30%, it means the person will get a loan worth 70% of the value of the security, which is rupees 2,800. Higher the margin requirement, lower will be the amount of loan granted, and vice versa. Next, we have the impact on liquidity or money supply, or we call it as the expansionary or cheap monetary policy. So basically what happens if the RBI lowers repo rate, then it will encourage commercial banks to borrow more funds, because it will become cheaper for them to borrow from RBI. And then the commercial bank then also reduces the rate of interest for the general public, which induces the borrowers to borrow more money from the commercial banks, because the cost of borrowing reduces, and as a result it leads to an increase in money supply. So this is how the whole process works. And on the contrary, if the Reserve Bank raises the repo rate, this will discourage commercial banks to borrow funds. As a result, commercial bank increases the rate of interest for the general public. This induces the borrowers to borrow less from commercial banks because their cost of borrowing increases, and as a result there will be a decrease in money supply. So this is how the process works when there is a contractionary monetary policy, or we call it a dear monetary policy. Let's understand how the qualitative and quantitative credit control tools work in order to expand or contract the money supply. To increase the money supply, there is a reduction in margin requirement. The RBI buys government securities. It lowers the repo rate, it lowers the bank rate, it lowers SLR, it lowers reverse repo rate, and it lowers CRR. So when such changes happen, this will lead to an increase in the money supply. In order to decrease the money supply, the RBI raises margin requirement, it sells government securities, it raises repo rate, raises bank rate, it raises SLR, raises reverse repo rate, and raises cash reserve ratio. Next, we have credit rationing. Under this, the central bank limits the amount of loan and advances that a commercial bank can provide. In other words, at the existing rate of interest of commercial banks, the demand for funds is more than the supply of funds, because there would be more borrowers, and the RBI has restricted the commercial banks um, to loan only a specific quantity of funds to the public. As the resultant is that supply of funds जो है वो कम है, लेकिन जो demand for funds है वो ज़्यादा है. This is how RBI influences the flow of credit. Then we have direct action. It involves direct dealing of RBI with these banks who do not abide by the rules and regulations of the RBI, and it could also involve imposing penal interest rates or cancelling the license of banks. So guys, that's all about banking series. If you find this series informative, then do hit the like button and subscribe to my channel. Happy learning and study smartly. All the best.